Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what these big companies are actually saying. This year, Schneider National Inc. is showing us their 2025 numbers, and let me tell you, there is a lot to unpack. They've had some big moves with acquisitions and are facing some interesting market shifts. Stick around, we're going to break down what it all means. Also, if you love getting the real story behind these financial reports, make sure you hit that subscribe button and don't forget to join our Discord community linked in the description below. So let's dive into Schneider National's 2025 report. They've been busy. First up, the company completed the acquisition of Cowan, a truckload carrier based in Baltimore in December of 2024. This move significantly boosted their dedicated and logistics operations. Then in August of 2023, they acquired M&M Transport Services, a dedicated carrier too. These acquisitions are a clear play to expand their services and reach. Now let's talk numbers. For the year ended the 31st of December 2025, their operating revenues hit $5.67 billion, up from $5.29 billion in 2024. That's a pretty solid increase of about 7%. But here is where it gets interesting. They like to break down their revenues excluding fuel surcharges. So when you strip that out, revenues were $5.09 billion in 2025 compared to $4.71 billion in 2024. That is an 8% jump. This tells us their core business grew nicely. Looking at their income from operations, which is basically their profit from their main business activities, it increased slightly from $165.2 million in 2024 to $168.9 million in 2025. That is a small but positive step. However, when you look at their adjusted income from operations, removing certain costs like acquisition-related expenses and severance, pay also went up a bit from $172.2 million to $177.6 million. This suggests their underlying business operations are performing well even with the added costs of integrating new companies. Their operating ratio is a key metric, and for 2025 it was 97.0%. This means for every dollar of revenue they generated, they spent 97 cents on operating expenses. It is a very tight margin and slightly worse than 2024's 96.9%. On an adjusted basis, their operating ratio stayed pretty much the same at around 96.3 to 96.5%. This really shows how competitive the trucking industry is, where every cent counts. Now let's get to the bottom line net income. It actually decreased from $117.0 million in 2024 to $103.6 million in 2025. This drop is mainly due to higher interest expenses and other costs associated with their acquisitions and a significant legal liability from a past incident. Even though their core business improved, the impact of these other expenses really hit their net profit. When you look at what is driving their expenses, salaries, wages, and benefits went up a lot by 13%, primarily because of those acquisitions. Fuel costs also increased by 9%. Depreciation and amortization also saw a substantial jump, mostly due to the new equipment brought in with the Cowan acquisition. Insurance expenses also went up by a significant 24% due to higher premiums and past claims. These are all tough costs to control in the transportation industry. Let's break down how each part of their business performed. The truckload segment saw revenues excluding fuel surcharges jump by 14% to $2.47 billion. This was a big win, mostly driven by their increased dedicated services following the Cowan acquisition and better rates in their network business. Their intermodal segment also grew revenues excluding fuel surcharges by 3% to $1.07 billion. This was mainly due to increased volume. The logistics segment saw a 4% revenue increase excluding fuel surcharges, reaching $1.33 billion. This growth was also helped by the Cowan acquisition, but was partly offset by lower volumes in their traditional brokerage business. On the flip side, their other segment, which includes leasing and insurance operations, actually saw its loss from operations widen to $28.8 million in 2025 from $11.1 million in 2024. This increase was due to higher corporate costs and insurance expenses, also impacted by those past claims. Now let's talk about cash. Schneider generated $637.4 million in cash from its operations in 2025, down from $686.1 million in 2024. This decrease is mostly because of changes in their working capital, like receivables and claims accruals. Their spending on new equipment and facilities, known as capital expenditures, decreased significantly in 2025 to $289.2 million from $380.3 million in 2024. This makes sense, as they probably front-loaded some of that investment during the acquisition period. Looking at their debt situation, their total debt and finance lease obligations decreased from $523.4 million in 2024 to $402.5 million in 2025. This is partly because they paid down some senior notes. They also have a pretty substantial revolving credit facility of $250 million and a receivables purchase agreement which gives them good access to funds if needed. One thing that really stands out is their claims accruals, which are money set aside for potential losses from accidents and other claims. These have increased significantly from $290.8 million in 2024 to $320.8 million in 2025. This points to the increasing costs of insurance and potentially more claims. They are self-insured for a large portion of this, which means they bear a lot of the risk. They actually mentioned that in 2025, their excess insurance limits were exhausted for one policy year due to an adverse verdict in a lawsuit, a pretty concerning detail. When companies buy other companies, they often record something called goodwill. It's basically the premium paid over the fair value of the assets acquired. Schneider has a significant amount of goodwill on its books, around $337.4 million in 2025. They have to test this goodwill annually for impairment, and thankfully so far they haven't had to write any of it down. But it is always something to watch, because if the acquired businesses underperform, that goodwill value could be lost, resulting in a big hit to their earnings. Their investments in marketable securities, which are essentially things they've invested in for a return, have a fair value of around $41.8 million in 2025. These are mostly US Treasury bonds and corporate debt securities. They also have equity investments in companies like Platform Science Inc. and Mastery Logistics Systems Inc., which are strategic investments designed to build their technology capabilities. However, they also had to record a $4.9 million loss on the dissolution of their investment in ChemDirect, a digital marketplace for chemicals. This shows that not all strategic investments pay off. Now let's talk about the risks. Schneider operates in a highly competitive and fragmented industry, and they are very upfront about that. They face intense price competition, which can really hurt their profits. They also rely heavily on attracting and retaining qualified drivers, which is a constant challenge. If they can't get enough drivers, or if driver pay goes up significantly, their profitability can suffer. Cybersecurity is a big one too. As a tech-enabled company, they are a target for cyber attacks, ransomware, and data breaches. A successful attack could disrupt their operations, lead to data loss, cause reputational damage, and result in significant fines. They are investing heavily in protecting their systems, but no company is completely immune. Like most large companies, they are involved in various legal proceedings. While they generally believe these won't have a material adverse effect on their financial condition, it is always a risk to monitor. One significant legal liability related to an adverse verdict from a 2017 incident is already impacting their interest expenses. Looking at leadership, Mark B. Rourke, their CEO since 2019, is set to transition to executive chairman of the board in July 2026. James Filter is taking on the president and CEO role. This kind of leadership transition is normal, but it will be interesting to see how the new leadership steers the company. So what is the big picture here? Schneider is a solid established player in the transportation and logistics world. They are making smart moves with acquisitions to diversify and strengthen their offerings, especially in dedicated and logistics services. Their revenue growth, excluding fuel surcharges, is positive, showing their core business is healthy. However, they are operating in a very competitive environment with tight margins and rising costs, especially for labor and insurance. The increased interest expenses and the impact of that legal liability are also a concern. Their reliance on self-insurance for claims is a double-edged sword, offering potential savings but exposing them to significant risk if claims spike. The goodwill from acquisitions is substantial, and though currently unimpaired, it introduces ongoing risk. On the positive side, their strong focus on technology and driver experience shows they are aware of industry challenges and are trying to innovate. Overall, Schneider seems to be navigating a tough industry with strategic acquisitions and a focus on technology. But they will need to closely manage their rising operating costs and the potential impact of insurance claims and legal issues to maintain consistent profitability. Their ability to pass on costs to customers and efficiently integrate acquisitions will be key to their future success. Alright, that is our deep dive into Schneider National's 2025 report. What do you think about their strategy and financial performance? Let us know your thoughts in the comments below. If you found this analysis valuable, please give this video a thumbs up and subscribe for more corporate insights. And don't forget to join the Corporate Decoder Discord community linked in the description. Thanks for watching, and we'll see you in the next one.